I'm about to show you something that could save you tens of thousands or even hundreds of thousands of dollars over your investing lifetime. And here's the scary part. Most investors never see it happening because the money isn't taken out of their checking account. They don't receive a bill. They don't write a check. The money simply disappears. Little by little, year after year, for decades. I'm talking about investment fees. Now let's be clear. Every investment has costs. Nothing is completely free. The question isn't whether fees exist. The question is, how much are you paying and what are you getting in return? Let's start with a term you'll see throughout your investing life: expense ratio. An expense ratio is the annual cost charged by a mutual fund or ETF to operate the fund. It's expressed as a percentage. For example, if a fund has a 1% expense ratio, that means approximately 1% of your investment is deducted each year to cover management and operating expenses. The important thing to understand is this: you never receive a bill. The fee is quietly deducted from your investment returns before you ever see them. That's why many investors underestimate its impact. Now let me show you why this matters. Imagine two investors, both start with $100,000. Both invest for 30 years. Both earn an average annual return of 7% before fees. The only difference? One investor chooses a low-cost index fund charging just 0.04%. The other chooses a higher-cost fund charging 1%. That doesn't sound like much. After all, what's 1%? But investing is different because fees compound year after year for 30 years. At the end of that period, the low-cost investor accumulates approximately $752,000. The higher-cost investor accumulates approximately $574,000. Same market, same starting amount, same 30 years. The difference? Nearly $178,000. Not because one investor was smarter, not because one investor picked better stocks, not because one investor took more risk. Simply because one investor paid higher fees. Let that sink in for a moment. 1% cost, nearly $178,000. That's enough to buy a house in some parts of the country. It's enough to fund years of retirement spending. It's enough to completely change someone's financial future. And here's what makes fees so dangerous. They don't take one bite. They take a bite every year. Imagine a tiny leak in a boat. At first, it doesn't seem important. A few drops here, a few drops there. No big deal. But if you ignore it long enough, that small leak can eventually sink the entire boat. Investment fees work the same way. Small percentages become large amounts when compounded over decades. Now, expense ratios aren't the only costs investors face. There may also be sales loads, advisory fees, account maintenance fees, and trading costs, and other charges, depending on the investments and services you use. That's why it's important to understand exactly what you're paying. Remember, a fee isn't automatically bad. If you're receiving value that exceeds the cost, it may be worthwhile. The problem occurs when investors pay high fees without understanding what they're paying for. One of the most important habits you can develop as an investor is learning to ask a simple question: what is the total cost? Not just the expense ratio, not just the advisory fee, the total cost. Because every dollar paid in fees is a dollar that can no longer compound for your future. Now open your workbook and turn to the fee check worksheet. Take a few minutes to identify every fund you currently own. Look up the expense ratio for each one. Then use the FINRA Fund Analyzer tool linked in your workbook to compare costs side by side. You may be surprised by what you discover. And that's exactly the point. Most investors spend their time chasing higher returns. Successful investors also pay attention to something they can actually control: costs. You can't control the market, you can't control interest rates, you can't control inflation, but you can control how much you pay. And over a lifetime of investing, that decision can make an enormous difference. Complete your worksheet, then join me in the next lesson where we'll explore one of the most powerful forces in all of personal finance: compound growth. The force that turns small amounts of money into extraordinary wealth over time.